In today's global economy, companies face many financial risks such as changes in currency values, interest rates, and commodity prices. While financial tools like derivatives are commonly used to manage these risks, many businesses also use natural hedges. These are strategic decisions within the company's operations that help reduce risk without needing complex financial contracts. Natural hedging is practical and cost-effective because it integrates risk management directly into the business, avoids extra fees, and doesn't rely on specialized financial knowledge. It also offers long-term stability by matching revenues and costs in the same currency or market, making it especially useful for companies operating internationally or handling volatile commodities. This approach helps reduce uncertainty in earnings and protects profit margins over time. Companies can use natural hedges by making strategic choices in how they operate, manage their supply chain, and handle financing. One way is currency matching, where revenues and expenses are kept in the same currency, like a European exporter selling in dollars but buying materials from the US to balance currency risk. Another approach is geographic diversification, spreading operations across different regions to lessen exposure to local economic changes. Commodity matching is useful if a company sells products tied to commodity prices. They can buy inputs with similar pricing to reduce volatility. Debt structuring involves borrowing in the currency of their revenue, helping avoid exchange rate risks on payments. Pricing strategies also help, using contracts that adjust prices based on currency or commodity changes. In real life, airlines often borrow in US dollars or link fuel contracts to ticket prices since they buy fuel in dollars but earn money globally. Car manufacturers source parts from the same places they sell cars to minimize currency mismatches. Tech companies like Apple and Samsung manage currency risk by making and sourcing components where they have major sales. The advantages of natural hedges include saving costs by avoiding expenses on financial contracts, simpler operations since risk management is part of everyday business, and effectiveness over the long term for companies with predictable costs and revenues. However, there are downsides, like the limited flexibility because operational choices can always be changed quickly, incomplete risk protection especially in volatile markets, and strategic limits that may lead companies to prioritize risk reduction over the most efficient sourcing or financing options. Natural hedges offer a straightforward and cost-effective way for businesses to manage financial risks by matching revenues with costs. This approach helps limit exposure to fluctuations in currency, commodities, and interest rates without needing complex financial tools. While natural hedging doesn't completely replace financial hedging methods, it plays a crucial role in a comprehensive risk management plan. Companies that use natural hedges effectively can achieve greater stability, predictability, and resilience, which are especially important in today's uncertain global market. This balanced strategy ultimately supports stronger shareholder value by managing risk in a practical, sustainable way.